Brief overview of subsequent measurement for equity method investments. The basics. For this discussion, I am focusing only on those stock investments where the company has significant influence. Remember, this is when the company owns between 20 and 50% of the outstanding shares. This is the situation that requires us to use the equity method of accounting. I hope you take a minute to watch the extra resource I have posted for equity method accounting. I think it's called the Equity Method Story. It will guide you through some numbers that will add a lot of context to what I am going to just talk about here on an intuitive level. Under the equity method of accounting, the company basically keeps track of its share of the investee company's retained earnings. If you're looking at the picture, you see a picture side by side of retained earnings and equity method accounting. But think through it with me. You know how retained earnings work. If I ask you what makes retained earnings bigger, you'll say net income. And if I ask you what makes retained earnings smaller, you will say dividends. Or you might say net losses, both of which would be correct. My point is that you know how retained earnings work. Whose retained earnings are they? Well, they don't belong to management and they don't belong to creditors. No, they belong to the owners who are the shareholders. See how much you already know? Okay, so the equity method of accounting just pulls what you already know about retained earnings into this equity investment account and requires that you keep track of your share of the investee company's retained earnings. So how does it work? Well, when the investee company reports net income, the equity method requires that you make an adjustment entry for your percentage share of the net income or loss. The equity method investment account balance will get bigger when the investee company makes money and would get smaller if they lose money. Remember that making a profit or not is not the same as paying out cash. So this entry will not include cash. It will only include the equity method investment account and either an investment income or an investment loss account on the income statement. When the investee company declares and pays dividends, the equity method requires that you debit cash for the cash that comes in, but requires that you make the equity method investment account smaller. Because remember, retained earnings get smaller when dividends are paid. And here you are keeping track of your share of the investee company's retained earnings. So there is no dividend revenue account used for equity method investments. In a separate overview, I'm going to expand on this with a complication to this very basic equity method accounting.